silver didn't just move today. It screamed. And if you weren't paying attention, you missed the message. It happened on Thursday, April 23rd, 2026. Silver touched 78.46. Let that number sink in for a moment. That wasn't a speculative forecast from a talking head on a morning news show. It wasn't some distant price target pinned to a chart for next year. That happened in the cold, hard reality of live market trading. And then, as if on command, the market violently collapsed, sliding all the way down to 74.12 within that same session. A $4.34 swing. In one day. If you're here for the first time, welcome. You've arrived at a channel that treats real assets with the gravity they deserve. We don't do hype. We don't do panic. We do mechanics. Because in a market this manipulated, this complex, and this misunderstood, the only edge you have is your ability to see the structure underneath the price action. And right now, the structure is telling us a story that most people are going to get wrong. Most investors are looking at where silver is. Sitting right now, hovering around. 75.29 on the bid, and they are sighing in relief. They're calling it a pullback. They're saying, it's just volatility, it's normal, it's healthy. And then they are going to close their browser, walk away, and completely miss the most critical signal this market has sent in weeks. Because today wasn't a pullback. It was a test. Silver ran at a technical wall, a critical level of resistance, and it got slammed. The way this resolves over the next 48 to 72 hours will define the next phase of this entire move. Either that rejection was a tactical shakeout designed to clear the weak hands before a massive leg higher, or it was the exhaustion print before a deeper, more painful correction takes hold. Two very different scenarios. Two very different realities. And we are currently sitting on the razor's edge between them. So for the next few minutes, I want you to clear your head. I am not here to calm you down, and I'm certainly not here to scare you. I'm here to give you the context. Because the context is far more important than the price. We are going to look at what gold is doing, what the gold-to-silver ratio is screaming at us, and why the divide between the paper price and physical reality is the most dangerous and most profitable dynamic in this space. Let's start with the immediate price reality. Silver traded at 78.46 today. That high was not random. It was the result of a calculated run at technical resistance. And the subsequent reversal? That is a textbook rejection candle. It suggests that at that price point, the supply of sellers outweighed the buyers. But here is where we need to look closer. We have to look at gold. Gold is currently at $4,692.30. Its high today was $4,953.60. Just like silver, gold spiked and then retreated by over $60 in the same session. When you see both metals hit a wall at the same time, you are not looking at retail panic. You are looking at institutional scale positioning. You are looking at a coordinated force in the paper markets that decided in this specific window that the price was high enough. Now, let's talk about the gold-to-silver ratio. This is the metric that everyone ignores, but it is the one that tells us the truth about value. Right now, at roughly $4,692 for gold and $75.29 for silver, the ratio sits at 62.3 to 1. Think about the history there. In a healthy, mature precious metals bull market, when silver finally catches up to gold, that ratio compresses. Historically, it doesn't just sit at 60. It drops to 30 to 1, sometimes 20 to 1. Mathematically, if gold simply holds its current ground, silver doesn't just need to rise. It needs to surge to bring that ratio back into alignment. This isn't speculation. This is structural pressure. The tension is already built into the market. But remember, the ratio is a structural argument, not a timing argument. It tells you what must happen, not when it happens. And in the near term, the same forces that pushed gold down $60 today can push silver down even further. But that leads us to the most critical divide in this market, the chasm between paper and physical silver. You have to distinguish between the two. The paper market, the COMEX futures, the ETFs, the cash-settled derivatives, is a world of notional exposure. It is where the daily price is set, where the volume is enormous, and where today's volatility was born. It is a market of digits on a screen. Then there is the physical market. The refiners, the mints, the electronics manufacturers, the solar panel fabricators, the individuals holding real bars in their hands. These participants operate in the physical world. When silver spiked to $78 this morning and collapsed to $74, did the global demand for industrial silver disappear? Did a solar panel facility in Asia pause its production line because of a paper price move? Did a semiconductor giant cancel its supply order because of a COMEX candlestick? No, they didn't. Physical demand operates on a completely different timeline. It is driven by the immutable needs of modern technology. As physical inventories of registered silver continue to decline relative to the paper claims against them, the paper market's ability to suppress the physical price becomes increasingly fragile. Today's paper correction is real. Your portfolio value shifted, but it is also a fiction. It is a snapshot of sentiment, not a reflection of supply and demand reality. The structural tension between these two worlds is widening, not closing. Consider the industrial demand. This isn't just supporting the bull case, it is the foundation of it. Silver has no viable substitute at an industrial scale. We are talking about solar photovoltaic cells, where silver paste is essential. We are talking about the cooling and connectivity hardware required for the global data center explosion. We are talking about the electrification of the automotive sector and the defense industry. These are not trends that depend on today's price. They are multi-year, multi-billion-dollar infrastructure commitments. Mine supply is not elastic. It cannot ramp up overnight to meet this demand. It takes years to bring a mine online. And while industrial demand is compounding, the available supply is tightening. So, when the paper market drives the price down while industrial demand continues to climb, all you are doing is creating a spring. The more they push the paper price down without addressing the physical shortage, the more violent the eventual release will be. Now we have to talk about the commercial banks. I know this topic brings out a lot of noise, so let's stick to the mechanics. The large commercial entities, the commercials in the Co-T reports, have historically held massive net short positions. This is public record. It is documented. It is not a conspiracy. It is a feature of the market. When silver touches $78, those short positions are under immense pressure. They have two choices. Cover those shorts, which would trigger a massive buying wave and push the price even higher, or double down by selling more paper contracts to force the price back down. The price action we saw today, that sharp, aggressive rejection at 78, bears the exact signature of the latter. It is an attempt to cap the market. But here is the truth that the paper sellers don't want you to realize. Short selling is a timing mechanism, not a permanent solution. You can delay price discovery, but you cannot delete it. Maintaining those short positions in the face of a physical supply deficit is incredibly expensive and increasingly dangerous. History shows us that when a heavily shorted market meets an immovable supply wall, the result is never a gentle correction. It is a short squeeze, it is sudden, it is violent, and it leaves those on the wrong side of the trade with no exit. This is the macro environment we are living in. We see gold at 4,692s. That price is not an accident. That is institutional capital, acknowledging that the global monetary system is under strain. The assumption of the U.S. Treasury as the risk-free asset is being questioned by the smartest money on the planet. Silver at $75 is just a shadow of that reality. We are in a period where short-term dollar strength and liquidity concerns create volatility, and that volatility is what we felt today. So, how do you handle this? This is the most important part of our conversation. If silver holds above that $74 mark over the next 48 to 72 hours, it confirms the rejection was a shakeout. It proves the market is ready to move higher. If it breaks below, it tells us the correction has more time to run. But in either scenario, the fundamental thesis remains untouched. If you are invested in silver miners, I need you to be very careful. Miners are not silver. They are equities. They are subject to stock market sentiment, operational risks, and most importantly, leverage. In a bull market, miners offer incredible leverage, 3, 4, 5 times the gains of the metal itself. But that leverage cuts both ways. When the market turns, miners don't just fall with silver. They can collapse under the weight of equity market risk-off sentiment. If you are holding miners with margin, if you are over-leveraged, you are at risk of being stopped out. You are at risk of the market deciding your exit for you. You need to size your positions according to your risk tolerance, not your greed. The structural thesis for the high-quality producers, the ones with reserves and manageable costs, is as strong as ever. But you need to be able to hold them through the noise. Think about the position you are in. You have the advantage of time. Institutional portfolio managers, the ones you are trading against, are trapped. They have to report quarterly. They have to answer to clients every 90 days. They cannot afford to be wrong for too long. They cannot hold through a drawdown without facing career risk. You do not have those constraints. You can sit on your hands. You can wait for the physical reality to reassert itself. That is not just an advantage. It is a superpower in this market. The anxiety you feel right now, that $75 to $70 fluctuation, that is a design feature of the market, not a bug. It is designed to extract the impatient and reward the patient. Don't let the paper price distract you from the physical reality. Solar installations, EV infrastructure, defense electronics, the shrinking COMEX inventories, none of these changed because of a candle on a chart today. The only thing that changed was the perception of the crowd. We are in the middle of a story that has been developing for years. We are not at the end of the book. We are only in the middle of a very important chapter. The gap between the paper story and the physical truth will close. And when it does, it will happen quickly, and it will favor the people who understood the mechanics, not the ones who panicked at the volatility. If this analysis gave you the clarity you were looking for, subscribe to this channel. There is more to come, and the next few weeks are going to be critical. We are documenting this shift in real time. I want to know where you think we go from here. Are you adding on the dips? Are you staying the course? Drop a comment below. I read every single one of them. The next 72 hours are going to give us the signals we need to confirm our next move. Stay disciplined, stay patient, and keep your eyes on the structure, not the ticker. Talk to you very soon.